and they've got no profit participation, so they've got a fixed kind of rate of return, an 8 current and 8 accrue. And then we brought $30 million of common equity that has all of the upside, on a $580 million transaction. And the weighted cost of capital on that deal was 5.25. So you've got basically 97% leverage at 5.25%.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Graham Sowden is the Chief Investment Officer at RREAF Holdings. Graham, welcome to the show.
Thank you. How are you doing, Sam?
I'm great, sir. I cannot complain. Graham, there are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start, where are you now, and how did you get there?
Oh gosh, 90 seconds. So started my career in the commercial real estate space at RREAF back in 2016. I was kind of in a floating analyst role at the time. I was probably the 8th or 9th employee. We were a much different, much smaller shop at the time. I pretty quickly transitioned into the director of acquisitions role and ran our multifamily acquisitions platform for about 6 years. And then towards the end of 2022, took on a new role within the organization as Chief Investment Officer.
That is fantastic. So you said you were employee, let me get this right, 8 or 9?
Yeah.
Okay.
So
I'm looking right now at your company website, and just a random stab would put it at 40 or 50 people at this point.
So we are somewhere between 400 and 500 employees nationwide now. And so that's, inclusive of our property management company and all of the on-sites, the leasing agents and maintenance folks. But we've got about 120 here in our corporate offices in Dallas. And then the rest kind of span throughout the South and Southeast. So we've come a long way since 2016.
Yeah, that's pretty explosive growth. What do you attribute that to?
I think that we have always been, kind of at the forefront of different investment theses and strategies. And, it was a lot of being in the right place at the right time. We back in, 15, 16 kind of identified multifamily in the South and Southeast, particularly in secondary, tertiary markets, as being, a desirable, investment kind of strategy for us. We were buying, mostly B minus type product in the early years, that all had, a light kind of value add component to them. And we found that we were able to buy at 200, 250 basis points kind of wider cap rates than you would if that exact same asset was located in one of the primaries or cores. And so, we were chasing yield, and our investors were chasing yield before any of the institutional groups had really, transitioned, I think, into those markets. And so, we were buying at 7.5, 8 caps, and ultimately in 2020, 2021, we were able to exit a lot of those deals at 3.5 caps. So tons of spread, built up a really, really good reputation in the marketplace with owners and brokers, and built up a really strong track record for our investors. And, it was just kind of natural evolution and growth.
Do you feel like it was just right time, right place situation, and you guys seized that opportunity, or was there something else you guys did to really create such incredible value?
That would be an easy way of looking at it, but it was definitely more strategic and more defined than that. We did have kind of the foresight at the time to go in and aggregate, big, a bunch of scale and all of these kind of overlooked markets, and had the conscious thought that, if we scale in all of these markets that the institutional groups aren't really looking at, but create, enough valuable and prove out this as a viable strategy, then these bigger institutional groups will be able to come in and write the bigger checks that they historically hadn't been able to write in these markets.
Right.
As we built out, a larger portfolio, and that's kind of exactly what we saw happen.
Wow, that's really great foresight, and that's a tough one.
We had a lot of people tell us that, we were wrong. So it feels good sitting here today.
Right, and not just because you get to say "I told you so," but because you were right and you got to reap the rewards of being right. So that's absolutely fantastic. How does your role, or how has your role changed in the company from acquisitions director to now the CIO?
It's stayed the same in some regards. I think, as the director of acquisitions, I was more specifically focused on the overall direction and strategic growth of just the multifamily platform. We have 6 other verticals internally, other, investment strategies that we take advantage of as well. But, that was kind of my main focus, was growing out the multifamily portfolio. And I'm still doing that, but it is kind of evolved into that role, a little bit more management now of, my team members and personnel, and overseeing the growth strategy for all of the 7 verticals at RREAF, not just, multifamily.
Got it. Is there a part of your previous role that you miss, or is it? I guess as you think about that, there's always transition and change for anybody as they grow and move into the next step or the next part of their career or business. So, any part of that that you say, "Man, I wish I could just still go do that."
Yeah, absolutely. There's a lot that I missed just about the last 6 or 7 years. It was a really good time to be in the space. And that's not to say that today isn't. It's just changed, and we have to adapt and, evolve some. It became kind of second nature, tying up deals and running them through our process and getting them closed. Um, so today things have like changed such that we have to be a little bit more careful, I guess, in the opportunities that we're going after and pursuing. So I think it's a really good time to focus like internally, operations and the organization, like on a holistic level, looking at management, looking at, asset management, property management, all of the things that kind of make us kind of run, and fine tune everything at the holding company level.
Yeah, I can certainly see that. And how for you guys, I mean, you saw it in the front end in 2016. You said, okay, hey, you know what? We're going to buy all this stuff. We're going to aggregate it. We're going to operate it professionally, such that institutional capital and other sources will want to come in and then buy it from us. So you've seen kind of that whole cycle occur. And I think on the multifamily side, what are we down, like 75% this year? I think on transaction volume. I mean,
Yeah, I was actually quoted in a Wall Street Journal article 2 or 3 weeks ago, and the title of the article was "Apartment Sales Are Down 74% Year to
okay.
Date."
Yeah.
So you're right on.
Yeah, I mean that's an astounding number, or astounding decline, I guess I should say, in
Right.
transaction volume. Does that create any opportunity for you guys, maybe that wasn't there a year ago?
Uh, Short answer is yes, and I'm sure you've talked to a lot of other multifamily owners and operators, and I think everybody kind of shares the same sentiment that, there was a lot of irresponsible investing between 2020 and 2023. You saw syndication groups kind of popping up everywhere and, chasing what was at the time, the most popular investment asset class in commercial real estate, multifamily. And I think people kind of forgot about the fundamentals and, were buying to buy. There were a lot of shops that were set up as, fee driven shops that would go out and overpay for an asset, which kind of ultimately contributed to that, bubble that we may have been in. People were borrowing money irresponsibly, I think, extremely high leverage, floating rate debt, short term, going in to a lot of these deals with negative leverage whereby you have to underwrite, 10, 15, 20% rent growth, just to meet your debt service, just to basically break even. And that's assuming interest rates don't rise. And, as interest rates rose, it was kind of just this confluence of issues. Insurance kind of, insurance rates just skyrocketed due to all, the losses that the insurance companies had sustained through, natural disasters and the like. And, taxes have been an issue in a lot of areas. And then interest rates being so high all kind of contributed to, like, values kind of plummeting in the last, call it 6 months. But, again, I don't know if it's luck or foresight. I mean, this was kind of a constant internal debate that we had over here, whether to, fix or float our agency debt. And, we always opted to fix everything. And, a large majority of our portfolio has long-term fixed rate agency debt. And so, we're kind of prepared to weather any storm, any, rise in interest rates. I mean, some of our biggest portfolios, are locked in with sub 3% interest rates for 10 years with 6 years of interest only at 80% leverage. So, and there are a lot of groups that were very successful in the short term, buying a property, fixing it up and flipping out of it, and, having the ability to flip out of it in such a short period, because most of those floating rate, debt instruments have maybe a 12-month lockout, and then there's a 1% prepayment penalty versus having to pay yield maintenance or defeasance, which, can devalue one's exit. So a lot of groups were able to get into these deals quick, turn them around, 18, 24 months later, exit, and they hit a home run. But, it's not sustainable. And as soon as you find yourself in a market with, varying or distinct attributes from what I just described, you're going to have, I think, some pain and suffering amongst those groups that, took out those risky loans and weren't able to see the 15, 20% rent growth that they had underwritten, and they're going to be upside down in a lot of their deals. And so that's where the opportunity lies.
Yeah, that's the unfortunate gambler's curse, where you go gambling and you make
Hand fallacy.
What's that now?
The hot hand fallacy.
Right. Yeah. You're like, hey man, I went and we made a bunch of money real quick and easy, and we can just keep doing that. It's like, well, yeah, maybe. Maybe you
Yeah.
just got lucky and you ought to just go home. So
Yeah.
yeah,
I think it was I think it was Warren Buffett that said that as soon as the tide comes out, you're going to start seeing who's swimming naked.
right. Right. Yeah, there's that. And I think on the flip side of that, though, you guys having everything is fixed rate. I mean, what did you say, sub 3%? I mean,
Yeah, we did at the end of 2021. We did a portfolio dubbed TC21. It was the Transcoastal 21. It was made up of 3 different sellers that we had kind of, pieced together, 21 properties all throughout the South and Southeast. I think we bought it at probably a 5.5 blended cap rate. We locked in 10-year fixed rate money with Freddie Mac through Berkadia out of Dallas. at 271 with 6 years of interest only. And so it was a $580 million total capitalization. We had $406 million of first lien debt at that 271 rate. We brought in a very good partner of ours, 3650 REIT. They're out of New York and LA and Miami. It's CalSTRS money and New York PERS. But they came into a pref position that took us up to probably 90% leverage with a weighted cost. They were about 10%, 10.5% money at the time. And then we brought in another group called DLP in a priority equity position that took us up to about 97%. And, they've got no profit participation. So they've got a fixed kind of rate of return, an 8 current, an 8 accrue. And then we brought $30 million of common equity that has all of the upside on a $580 million transaction. And the weighted cost of capital on that deal was 5.25. So you've got basically 97% leverage at 5.25% money.
Right.
So,
That's astounding. What you just described is beyond advanced for many probably of our listeners. Like,
I apologize. So
no. You don't have to break it down. By no means. I'm just saying that I understood everything you said, and I think our listeners will too. But yet, it's a strategy that many of us, myself probably included, I go, gosh, that's a lot of moving parts to assemble.
It is, and that's kind of what has always separated us from a lot of groups. We've got a lot of 30+ year vets over here, a ton of experience throughout all sectors of commercial real estate, and we have found that we can put together some of the more creative structures to maximize our returns to our investors while mitigating as much risk as possible. And, our track record kind of shows that. It's not always the cleanest deal. A lot of times, any new groups that we're working with, it's a learning curve. Even the agency lenders, a lot of times, have to come to terms with what we're trying to structure, but it's panned out really well for us. So we kind of created some of those different tranches of capital, and we got Freddie Mac to sign off and become comfortable with them. So.
Wow. Yeah, I can only imagine that was a tough hill to climb, because those agencies, they're not exactly ones that, color outside the lines.
No, they're not. So, but we have the benefit of being select sponsors. And so, there's maybe 40 or 50 select sponsors every year, and it goes the biggest borrowers for Fannie or Freddie. And what you get is you kind of have a direct line of communication with the agencies, and you can kind of create or give feedback to some of the programs, and tell them what the borrower wants, and they can hopefully help accommodate. You also get preferred pricing and queue times and things like that. But
man, this is fantastic. You have given us so many things here to think about. I love just hearing the journey. Would you say you came on as person number 8 or 9?
Yeah.
There at the company, and then here talking about a deal 5 or 6 years later where you guys are assembling a $580 million portfolio buy. That's a lot of progress in a very short period of time. As you look back over the past, call it now 7 years, what is one piece of advice, or what's one piece of advice you'd give to somebody, or maybe even to yourself, if you were starting back over right here in 2016?
Oh gosh, I could take this in a lot of directions. I think one is just go do it. All of us can sit around with our buddies and talk about the greatest ideas or the greatest investment strategies in the world, but none of it means anything unless you get out there and go do it. That's kind of this company, RREAF has become this big, well-oiled machine, but it wasn't always that. It didn't start out that way. We were cowboys, we were gunslingers. We had, all of the tools, we had all the experience, we had, the right guys. But, we had a good idea and we went out and we got it done. I mean, you learn a lot just by doing it. You're not going to know all the answers. There's such a thing as analysis paralysis, where, you think of all of these what ifs and hypotheticals, and it just bogs you down into, not getting out and actually doing the work that needs to be done. So, I mean, there's a lot to just like FOF is what I always say, feet on the floor, in the morning, put your feet on the floor, get out of bed and just start the day, like you never know where it's going to go. It's always going to be a good day if you just put your feet on the floor.
Get your feet on the floor. Graham, I love it. Thank you for taking the time here to come on the show today. It's a bummer. I've got lots more questions here for you, but we are unfortunately out of time. If our listeners want to get in touch with you or learn more about you, what is the best way to do that?
Well, you can go onto our website, RREAF.com. If you're interested in investing, we have an investor portal. We've kind of created a digital marketplace for all of our offerings. We typically have, 5 to 6 different investment offerings at any one time. You've got to be accredited to actually invest, but we do the accreditations here internally through our legal department. Otherwise, all of my contact information is on our website. You can find me on LinkedIn, and I'm always happy to get on the phone and talk with anybody about anything. So if you find my cell phone, I'm not going to give it to you on your podcast, but if you are able to find my cell phone, you can give me a call anytime and I will take it.
That sounds great, Graham. Very generous of you. Certainly appreciate your time here today. And we'll make sure we include that there in the show notes. For those of you who are listening, that's RREAF.com, spelled RREAF. RREAF.com. Graham, thank you again for your time. Have a great rest of your day.
Absolutely. Thank you, Sam. And you have an incredible podcast voice.
Thank you, sir. I appreciate it. Talk soon. Bye-bye now. Hey, thanks for listening to the How to Scale Commercial Real Estate podcast. If you can do me a favor and subscribe and leave us a review on Apple Podcasts, Spotify, Google Podcasts, whatever platform it is you use to listen, if you can do that for us, that would be a fantastic help to the show. It helps us both attract new listeners as well as rank higher on those directories. So appreciate you listening. Thanks so much and hope to catch you on the next episode.